Well, hi everyone, Shaun Humphries here. Welcome to the Wise Wealth Podcast. Well, in this edition of the podcast, my son Joshua and I are going to talk about some of the major themes, financial themes of the past week. And the themes will range from, Canada Pension Plan. What drives people to make decisions on when to take their Canada Pension Plan benefits? We'll also talk about the current state of capital markets and more specifically, the output difference in GDP performance between the United States and Canada, and that could lead to some concerning trends, particularly as it relates to Canadians' standard of living. We'll talk about some of the major changes that you're going to be confronted with for your 2023 tax filing. And finally, we're going to talk about sort of a philosophy of learning. We're going to talk about the Dunning-Krueger Effect, and that particular discussion on learning and its impact on us, how it can create some blind spots and overconfidence, is an interesting discussion. I think you'll enjoy it. Now, the podcast has been divided into different chapters for those topics, so please feel free to skip around between the different topic areas that kind of pique your interest. As well, in the show notes for the video, you'll see links back to some of the topic areas if you want to go into it in more detail. Anyway, hope you enjoy the podcast. Please feel free to leave comments on future podcasts, information you'd like to see us cover. You take care. Well, hi, everyone. Welcome to the Wise Wealth Podcast. It's a pleasure to get together with Josh again. Hi, Josh.
How's it going? It's a pleasure to be here.
Very good. So we got a full agenda, and Josh and I continue to refine this podcast. We're going to eventually cross the finish line on it. So I think it's more and more going to be more of almost a news magazine podcast. We're going to talk about different topics, things that are topical in the news, and we've got a great outline. So maybe you can share with everyone some of the main topics we'll be covering off today.
Yeah, so I think based on our conversations, there are a couple of things we wanted to cover today, and I think the first one is a discussion on CPP. So I know you've been pumping out a lot of videos recently on your YouTube channel, getting into nuances surrounding the Canadian Pension Plan. And so we thought it'd be a great topic to discuss a little bit longer form on this podcast and dive into some of the nuances there. Next is kind of, do you want to discuss what you meant by knowledge and kind of like the...
Well, in science, there's a whole thought process around the philosophy of knowledge. And I'm going to cover off one of those philosophies as it relates to financial planning, retirement planning.
Right.
So it's kind of an interesting way of looking at our blind spots. When we look at financial planning, sometimes we have blind spots, and those blind spots can hurt us.
Yeah. And then tax. So we're going to cover a couple areas concerning tax.
Yeah, I think the main things, we'll just cover off some main points on your 2023 tax filing.
Okay.
So some of you may have already done your taxes, but for those of you that haven't, I'm going to cover off some main changes that affect people for 2023. And we'll also have a link. So the information we're covering off, I won't go through all the changes, but we'll include a link in the show notes to a document or a website that'll cover off those changes.
Perfect. And then we're going to wrap it up with a kind of market theme, market update, which is the norm on this.
Yeah, perfect.
All right, so topic one, CPP. So I know in the conversation with CPP, a lot of times people have differing opinions on when they should take CPP and the reasons, benefits of choosing different ages, whether it's like 60 or wait until you're 70. What are some of the triggers that Canadians cause Canadians to take their CPP at different ages?
Yeah, I mean, it's complicated at one level and not very complicated because it looks like, based on the data, that most people do a certain thing consistently, but before they make the decision, before they trigger their Canada Pension Plan, they kind of wrestle with some of these points. So first of all, we have to recognize that for many Canadians, Canada Pension Plan is a cornerstone part of their retirement income. So when you add Canada Pension Plan and old age security, they're important decisions for sure. And one of the toughest decisions for people when they look at their retirement and their government pensions is when to start. And I'll tell you right now, the most popular time is early. And so most people will start their Canada Pension Plan before the normal CPP start date, which is age 65. So most people will take it between under 65 and as early as age 60, which is the earliest that you can take it. So it begs the question, though, if you look at a lot of the YouTube videos that are out there, if you look at the advice out there, and if you talk to an actuary, they'd say probably the best decision is to take Canada Pension Plan at age 70, not at age 60. So why is it that most people will take it early? What's driving that particular decision? Because it may not actually be the right financial decision for people, but it's the one that people seem to be taking. So I kind of wrote down a few things that drive that decision. So the starting point with Canada Pension Plan is if you defer it, let's say I defer my CPP benefit from 65 to 70, I increase my benefit by 42% from the age 65 benefit. If I take it early, let's say as early as age 60, I reduce the benefit by 36%. Okay, so it begs the question, why take it early when you get such a big hit to the benefit? There's a few reasons, like I said. I think that one is a basic human trait that we refer to as present bias. So when we're looking at something right now and it's front and center, there is a natural bias for people to want to take it. It's just a behavioral thing that we do. And so that drives some of the decision making. Or behind the scenes, it's kind of lurking in the background. So we may not be conscious of it, but if we can rationalize the idea of taking it early, with this sort of present bias might drive us towards that decision. There are some practical reasons for taking it early. Some people will take it early because they just need the money, right? They're transitioning into retirement. Maybe they don't have a lot of savings, so they need the money. Other people will take it because they have a generalized belief that life is uncertain. So I'm going to take the money and run. I've put 30, 40 years of contributions into the plan. So do I really want to leave money on the table if I die prematurely? Because for a lot of people, if you're in a couple situation, made contributions, your partner's made contributions, the survivor benefits are meager. So a lot of people go, well, if I die prematurely after 40 years of contributions, that's not great, right? I'm leaving a lot of money on the table. So take the money and run's a very big thing. You know, the quote that sometimes you hear is, you know, a bird in the hand or a bird in the hand is worth two in the bush. I'll take it now and have it. There's another interesting point of view, which I think definitely has merit. Like even if someone is kind of gaming which makes more sense, let's say you didn't need the income, you might rationalize taking it early if you're going to invest the money, right? So you'll take the penalty, but then you'll invest the money in your tax-free savings account and you go, well, that's going to compensate for the fact that I have this penalty and I'll let that money grow and accumulate. And again, you do that sometimes because of that take the money and run. Let's get the money out of the plan just in case something happens to me and I die prematurely. Those are some of the reasons. I guess another reason could be just even tax rates. So if you've got somebody who's still working past age 60, into 65, maybe up to 70, they may look at these benefits and go, listen, if a lot of it's going to get taxed away, a good example is old age security. Some people who are working past age 65 might experience clawback, and they may lose a lot of their old age security benefit. So people sometimes will defer for that reason. But the bigger reason people defer is, and take it at age 70 or later, as a small percentage of people, is they're concerned about longevity risk. They want the maximum income. Increasingly, people are just healthier at age 70, and so they're still active and doing things. And a lot of calculations get done, but quite frankly, I mean, if you take it early at 60 as opposed to age 70, you're probably walking away from at least $100,000, right? Just in making that decision of cash flow, right? So you're kind of going, yeah, I might be pessimistic about how long I'm going to live, but you know, that's understandable, I guess. But that's where actuaries go. In fact, we just did a YouTube video on this discussion. Mm-hmm. There was an actuary that did a calculation and said, well, you know, when are you further ahead taking CPP early at age 60 compared to somebody who's going to take it at 70? And the actuary calculated, looking at the numbers, that if you die before you're 80 years and 6 months, you're better off taking it at age 60. If you live past 80 years and 6 months, you are not a winner. And if you look at actuarial tables, about just over 19% of people win in that calculation. Actuarially, most people will live past 80 years, 6 months.
Yeah.
Right? So it's an interesting psychological sleight of hand. People are pessimistic. They want to take the money and run. But from an actuarial standpoint, actuaries would say, this doesn't make sense. Like, look at it from a realistic standpoint. Will there be a big chance you're going to die prematurely? If you're healthy, probably not. But it's an N of one, right?
Yeah.
We don't know how long we're going to live for.
I wonder how much of that is just a general distrust of the government and the government's ability to handle funds. You know, just It doesn't matter what the numbers say. I just don't like the money being over there. I like to have it.
That's a really good comment, and I'd say that as it relates to Canada Pension Plan, it's probably one of the few programs. I'm sounding critical here, but when you look at what government does, they did some really important things to Canada Pension Plan years ago. They worried about the funding of the plan. They've been increasing contributions. They turned over the management of the assets to Canada Pension Plan Investment Board. They've done an amazing job. That plan is fully funded going on the next 75 plus years. So from a government standpoint, it's now more arm's length. It's one of the few programs where you go, I think this thing's pretty solid because of the way they've structured it. I do think that even with Alberta's recent announcement that they want to pull money from Canada Pension Plan and do their own thing, create some concern for people, that's not going to happen. I mean, Premier Smith is doing that because she's trying to create some leverage when she's negotiating with Ottawa on other issues. So Canada Pension Plan, I think, is fine. Old age security, which is another part of the pension discussion, we might want to worry about that one more. I don't think that the government's going to cut that benefit. It's an entitlement program. If you get the full benefit if you've been living here for 40 years, up until your 65th year, and you'll get the benefit of it. What the government's going to do, though, is they're going to start raising the clawback levels. So the amount of income that starts the clawback will drop. People won't have to make as much money to be hit by clawback. If you look at old age security payments, it's one of the largest budgetary items that the federal government has. And so they're going to be looking for ways of paying out less of that benefit over time, but they'll probably do it in sneaky ways so the average person isn't really noticing. But that's probably the one to worry about it more.
Yeah. I was watching a video about a guy talking about some tax issues surrounding CPP, and he kept emphasizing that it's not taxation, like it's coming off your paycheck. It's not tax, right? It's your money. Yeah. But then you look in the comments, and a lot of the comments are like, well, like, how does it work when I die? Like, do I get the money back? So what happens if you die? Is there a way to get that money to your spouse, or?
Well, it's a good question. So first of all, Canada Pension Plan does have a lump sum death benefit of $2,500 that your partner will get, as an example. There are spousal benefits on death. The problem is, the benefit amounts might be meager. So if you've got, like the more common scenario that I tend to see with a lot of families, many years ago, you'd have a primary breadwinner, working and paying the bills, and you'd have typically a mom at home, and you'd have the kids at home, and that was the way things were structured. And as the years have gone by, it's more common for both to be working, both to be making contributions to Canada Pension Plan. Probably both are at the maximum insurable earnings, so they're putting maximum contributions in. So when you look at a scenario like that, if there's a death of one of the partners, there'll probably be no or very little top-up in terms of survivor benefits. So in that situation, that can be a real concern. I've put 40 years worth of contributions in this thing, and if I drop dead the first year of retirement, I've left a lot of money on the table. Yeah. Right? So it is a concern. I mean, again, actuarially, would it happen? Is it likely? Probably not, unless you're really pessimistic, you've got bad health or that kind of thing. But yeah, the survivor benefits are meager. Yeah.
So yeah, we could talk about CPP for hours, especially the tax consequences of it. But
and actually, Josh, I'm just going to make a comment on CPP. It is a very personal decision. So as you can see, a lot of factors go into it. You can run the numbers and very often justify taking it later makes sense, but it's going to be based on your goals. Life expectancy assumptions, liquidity needs, income needs, pension splitting opportunities. Take the money and run. Maybe you'll invest the money, put it in your TFSA. So each one of you will be unique. There's no sort of boilerplate recommendation in the area.
Yeah. Right. Awesome. So moving on to section 2, we wanted to touch on knowledge, the theory of knowledge and applying it in our own lives. So Aristotle famously wrote, the more you know, the more you realize you don't know. And admittedly, you could apply that to pretty much every area of my own life. I've started a lot of new things, and you gotta take your place at the bottom of the hierarchy, especially when you don't know what you're doing. So whether that's sport or classes or school, before you can become a master, you gotta be the fool. So what want to elaborate a little bit on what you want to talk about with that?
Yeah, like I think it's relevant because when you look at the data out there around financial planning and finances and accumulating wealth, an awful lot of people don't hit their goals, and I'm going to share some information that will sound very self-serving, but the data bears this out, is that advised households have more financial success and wealth than non-advised households on average, right? So people may choose not to believe that data, but it actually is very true. And there's a lot of reasons for that, but one of the reasons is this concept, and I'll put on the screen right now an image of the Dunning-Krueger effect. And it's a real effect, and most of us have probably succumbed to this effect in the past. If you look at the horizontal axis on this chart, you're going to see it goes from knowing nothing to being a guru, and gaining a lot of wisdom over time on a particular subject matter. And then on the vertical axis, on the left-hand side of the chart, you're going to see confidence. And you're going to see, though, a fair amount of volatility in that confidence measure in this Dunning-Krueger effect. And the Dunning-Krueger effect basically is the more you begin to learn about something, truly learn, the more, based on what Aristotle said, the more you realize you don't know. But when we start learning new things about a new topic area, let's say, Josh, you start, and for you, I mean, the whole financial area, you come through high school, you're finishing your commerce degree, you're going into finance, and you can't help to know you don't know everything. There's lots of things you don't know. And so this is this learning journey that you're on. And so what happens is you start with almost no or zero knowledge in a subject, and you start learning. And you have these aha moments. Yeah. Oh, you kind of figure out. It's the first time you're doing let's say an algebra or calculus equation, and all that stuff clicks in, and obviously you've got confidence. Like you feel like you really know this stuff. And that's a very dangerous zone to be in. You know enough to be dangerous.
Well, because you stop there, you know?
You stop there. I kind of figure it out, right?
Yeah.
And the Dunning-Krueger effect is hilarious because if you look at the chart, they call that the peak of Mount Stupid, right? So again, you feel like you know something, and you start making decisions based on that knowledge. And then what happens is you start experiencing real life, and you realize, either because you're talking to other people or you have experiences in real life that are negative, because you've taken some actions based on being on the peak of Mount Stupid, and you realize after the fact, I wasn't as smart as I thought I was. Okay, so it's a dangerous area to be in, and I think there are certain personalities that are more inclined to be like that.
Yeah.
So when I talk to clients, and I say this very respectfully, right, because we're all different, we're all wired different. So I have many clients who are very self-directed, and for whatever reason, they're able to come to the table with a lot of humility and take direction and advice. Now, for some of them, they're business owners who are very directive in their businesses, but they're used to working with their lawyer, their accountant, their business consultant, their financial planner, and they're used to paying for professional fees, acting on the advice, and seeing the benefit of that relationship over time. But not everyone has that kind of experience. So if you're inclined to be very self-directed, very motivated to research things and do it on your own, which is a good thing. I'm not saying that's a bad thing. What can happen is you're kind of doing stuff in isolation. You're reading some literature, you're watching some YouTube videos, you're trying to make sense of things. But what happens is you're climbing to the point where you've got some knowledge, you start acting, and you don't know what you don't know. So I'll give you a couple of examples. So you can see on the chart, you hit the peak of Mount Stupid, then you go through some experiences, and you get into the valley of despair.
Yeah.
And then you begin to realize there's a whole depth to this topic that you never knew existed, right? And now you're on this gradual, increasing experience of gaining wisdom and gaining more and more confidence. You had faulty confidence, really confidence born on nothing. Now you're building real confidence. And I'll give you a couple of examples. One is from my stepdad. My stepdad was a very successful architect for many years. And, as he ran his firm and then he merged with other firms, and the latter stages of his career, he was, the senior architect, right, the kind of leader. And he used to kind of laugh a little bit at the young architects. So he said they're brilliant. And they could use these CAD systems. It was amazing. They could draft and do design work, and they're on the computers, and they could pump out all these designs. And he said, the funny thing is, I'm more productive. Like I've got the blueprints on a table. I'm drawing out freehand, and I got my ruler and my design pens, and I could come up with a design in half the time. It was way more efficient or productive. And he said it wasn't because I was smarter, but I had all these years of experience. I had sort of this generalized pattern recognition. I knew based on the client's expectations or goals, my experiences of the past, I could come to solutions really, really quickly. The young architects, they had knowledge, but they didn't have any experience. There was no pattern recognition. They were constantly able to research, reiterate, because they didn't have any deep well that they could draw from. And I even look at our experience in the financial industry. Yes, you learn as you go along, and every advisor better be a lifelong learner, but you also have literally hundreds of case studies that you've experienced over the years, right? So in our practice, every single year, we experience every conceivable life event that a person could go through. Like literally every event. You name it, our clients go through. Death of a partner, aging parents, retirements, separation, divorce, kids graduating, newborn, like it's all grandchildren, all those experiences. And all those experiences have financial implications, retirement certainly. So if you as a client, or if you are a do-it-yourself or trying to do your own stuff, the question is going to be, what will the results be 10 years down the road if you're collaborating with a team that's helped hundreds of families go through retirement and learn along the way, to you as an N of one making those decisions? Your friends over coffee will tell you a few things. You got some buddies maybe that are retired, some friends. They tell you about the good things. They don't tell you about the bad things. So you're an N of one trying to make it work. And that's a value. When you're talking about knowledge, how do you push back against the peak of Mount Stupid? I'm not trying to be disrespectful here. I mean, just the reality for all of us is we're learning. It's a lifelong journey. But can you be coachable, right? As you're learning things and you think you've got it mastered, coming to a topic with a certain degree of humility, and that applies to everyone in every arena, allows you to be adaptable, that you can pivot, you can change, you can nuance along the way, so you're not getting too quickly into the valley of despair and finding out you made some bad decisions along the way. So that was my thinking about the Dunning-Krueger effect. It can lead to overconfidence. Collaboration and coaching can help keep that from happening. And then approaching topics like retirement or finances with a little bit of humility.
Yeah. Yeah, it's funny. I don't know. Are you going to put up the graph with the valley and everything?
Yeah, yeah.
It's, if you can see it, I feel like their line towards the plateau of sustainability and the slope of enlightenment, it should be more, it'd be a smaller slope. It's a lot longer of a process.
Yeah, it looks kind of optimistic there, right?
It's like a couple extra years than the first increase, but no, I think it's in reality a lot longer than that.
Yeah, it's funny how that wisdom continuum is. It's a slow, gradual journey, and it comes through experience, networking, new knowledge, testing that knowledge. Yeah. Right. Learning from those tests.
Pressure.
Absolutely. Yeah. And in fact, as you go along that continuum, like that wisdom continuum, there is another psychological experience that people have. It's not the same thing, but it's connected to this. And that's imposter syndrome. Yeah. So you have people out there that you're going, like, that person's a gifted surgeon, or they're an amazing trial lawyer, right? And they've been practicing their craft for 20, 30 years. And psychologists will tell you so many people, maybe the majority, have moments of imposter syndrome, where they're wondering whether they, like, how did I get here? Do I really, should I be here? Do I have the smarts to do it, right? Well, they've gone through that continuum. They've gained wisdom. They may even be at guru status. But what happens is they're benchmarking and comparing themselves to other people who have gone through the same experience. So when you're in this sea of really gifted, high capability people, that can lead you to question yourself. Yeah. And that can actually crush people's confidence, which is a really unfortunate thing, because they're good at what they do, they're knowledgeable, they're making a difference, but they're in a sea of people who are amazing as well, and they start going, do I deserve to be here? Yeah. Yes, they do. Yeah. But you want to fight against that because, struggling with confidence in any profession makes you less capable to really deliver to your clients what you need to be delivering.
Yeah. It's funny, imposter syndrome, it's like the opposite of the norm, which is you judge yourself not very hard, and then you judge everyone else kind of more harshly, right?
Yeah.
And it's just the inverse of that.
Yeah, exactly.
Yeah. Was there anything else you wanted to touch on before we move on?
I think that's the main thing. I mean, it's one of those topics that, I want to be careful how I position it. I'm not saying people shouldn't learn, and I'm not against do-it-yourselfing in most areas, right? It's just that you just want to be conscious of that's an effect, and be open to advice, be open to coaching, be open to other ideas.
Yeah, that's good. Next section, some 2023, 2024 tax changes you want to touch on?
Yeah, there's always lots of changes going on when it comes to tax time. So what we're going to do is we're just going to cover off just a few of the changes. So we'll have a link in the show notes for the video that will take you to a more detailed article on some of these changes. I thought what I would do is I would just cover off some of the ones that have come up more recently. Now, Josh, do you have the outline on your screen?
Of the list of I have it.
Well, why don't you cover that first one I've highlighted there? So first home savings account.
Yeah, so we did a podcast on this, a little bit longer video. I don't know how many ago that was, but it's good to review it. So the first home savings account is basically another tax sheltered place you can park your money, specifically for the purpose of buying a home, unless you can move into an RSP or something like that. So in 2023, it was introduced to help first-time home buyers save for a home purchase. So if you made an eligible contribution in 2023, you can deduct it on your 2023 tax return or claim it in a future year instead. So if you have higher income in a future year, it can help kind of reduce that.
Yeah, exactly.
Deferring the deduction, they say it here, would make sense if your future income is higher in the next couple of years. So.
Yeah, and so again, you can deduct it if you actually got the money in, before the deadline. Yeah. But for those of you that will be buying a house, if you've got some younger people in your families, you make sure that they're aware of the first home savings accounts. Another area which I thought was important to note was residential property flipping. This has been, I think it's an important one. You look at the real estate market the last little while, man, it's just been so hot. And, I look at you and our kids and the cost of real estate and when I finished my business degree, and Tanya, my wife's a teacher, we didn't even think twice about, in the late 70s, early 80s, we didn't think twice about, okay, we're just going to buy a house. Yeah. Went and bought a house. It wasn't a concern. You look at it today, and the low interest rates for the last number of years, which has fueled a whole bunch of liquidity into the real estate market because money was cheap, has bid up the prices dramatically. And real estate flipping has been part of that problem. So a new rule came into effect January 1st, 2023, to ensure that profits from flipping a residential property will be taxed as business income, not a capital gain. So if you own property for less than 365 days, and there are some exceptions, then it'll be just considered regular income. So it'll be taxed at a higher rate than capital gains income. Mm-hmm. So I think from a policy standpoint, that's, I think, a good move. It's going to take some of that short-term trading and bidding, and you want a stable, sort of predictable real estate market there for people wanting to buy homes for the long term, and these flipping strategies just really disrupt, I think, the real estate market in many ways. Another important one is multi-generational home renovations. So this will continue to be a really important area in Canada if you see the aging demographic and families trying to help one another, so you can claim a credit on up to $50,000 of costs for a qualifying renovation to allow a senior member to live with another family member. The credit will save you up to $7,500 in tax and applies for expenditures starting in 2023. So the specific schedule you'd use is Schedule 12 in your tax return. The next one is working from home, because there's a lot of flexibility around working from home through COVID. So there used to be a flat rate method you could use for 2020, 2021, 2022. For 2023 and future years, we're right back to the old method, a detailed method for making a claim for your home work expenses. Another one that's, I've had some people in my circle complain about this, and that's tax reporting, so trust tax reporting. Any trust with tax year ending after December 20th, 2023 must file an annual T3 income tax and information return. This can include bare trusts, in trust for accounts, and jointly owned assets, which didn't require filing in the past. And there can be penalties if you don't file, and the trust returns are due 90 days after the trust year end. So that would be for this year, March 30th, 2024. So these are forms of trusts that have never had to file before, and there's a lot of people scrambling trying to figure out how to do this, right? And there hasn't been great guidance by CRA on how to handle it, and there's been some move to try to push the date back on this reporting requirement. Let's see here. I think those are the main things I wanted to cover off, but we'll have a link. We'll have a link to this particular article in the show notes.
Awesome. I think lastly, we wanted to cover some themes concerning the market. So, what did you want to start with on that?
Well, what I'll do is I'll put on the screen to start with just a discussion on Canada real GDP per capita, working age population. So what you see on the chart is a graph that basically shows you how GDP per capita of the workforce in Canada has gone up over the years since 1997. And there's been blips along the way. You can see the first blip that was meaningful was back in 2008, the financial crisis of 2008. You see a major downturn in, of course, 2020 when COVID hit. And then as we began to come out of COVID, we saw an acceleration of GDP. But what you're seeing in Canada is kind of a plateauing in 2022, and in 23, we've actually seen GDP fall. And the Alfred Lam, who's the analyst that put this particular piece together, made a few comments on this chart. I think that the first thing he would say is that this chart probably speaks to the relative weakness of the Canadian economy. So we're not seeing GDP increase, unlike the United States, which is showing increased GDP. We're not seeing increases in Canada. And it's one more indication that the Canadian economy, if not technically in recession, it's been just skirting the edge of recession. And I think the reason that's important to talk about is there's this ongoing debate about, will interest rates fall? The Bank of Canada governor recently said, we're going to hold rates, not increase them. Will they reduce rates? And if they do, how quickly? But the reality is Duff Macklin, Bank of Canada governor, is struggling with a couple of things. Number one, there is weakness in the economy if you look under the hood. Number two, for whatever reason, Canada has a very large amount of mortgage debt coming due this year and next year. And so if you're looking at economic health, one of the worries that both the government and the Bank of Canada would have is, do we just allow all these mortgages to renew into higher rates, or do we need to push rates down to create a little more stability within the economy? So I think the fragility of the economy currently, that is certainly there, but not reported on widely, and the fact that the mortgage market could really, really hurt the Canadian economy if we had renewals happening at higher rates, I think that will drive interest rates down. And in fact, for many of you, if you look at your statements and your portfolios, you're going to see that there's been some, decent momentum. We were talking about this the last 3 or 4 months. We thought that rates would eventually fall. What's happened is, although rates really haven't fallen, clearly the market thinks that rates will fall, right? And so the market is responding like rates are going to go down. And I think that there's a very high likelihood in Canada that you'll see rates coming down. I think that the big question for the Canadian economy is the question of our lagging GDP relative to the U.S. I think it's a really, really significant issue. We seem, from a public policy standpoint, to be going down a track where we are seemingly completely oblivious to the fact that we're losing significant ground to the U.S. from a productivity standpoint. And if you start doing that, then you're going to really hurt the quality of life for Canadians. And in my hope, I don't want to be, giving a political speech here, but my hope is that over time, people will start connecting the dots between, fiscal policy, sometimes monetary policy, and the impact of wealth creation and productivity in our country. And I'll just sort of review some data for the U.S. I'm going to read here what Alfred put down, and it's the contrast is huge when you look at the U.S. Okay, so the title of this paragraph is U.S. Productivity Stands in Stark Contrast to Canada. The U.S. Bureau of Labor Statistics announced that non-farm labor productivity grew by 3.2% annualized during the fourth quarter of 2024. That's huge. This adds to the 4.9% advance on the same basis recorded in the third quarter. In the U.S., productivity gains have been made in 5 of the last 6 quarters, and output per worker hour hit a new record high in the last report. Productivity growth is important for longer-term economic stability, as it reflects the country's competitiveness, allows for higher wages, faster economic growth without inflationary pressures, right? So you can see economic growth, as long as it's productive, it doesn't lead to inflation. It's when you're throwing money at the economy in a very sort of liquidity-based, let's hope it drives economic, that's not true economic activity. You want productivity gains. And so the U.S. has been getting that. It leads to a higher standard of living. So his comment was, which I agree with, unfortunately, Canada's been reporting very poor results by comparison. Canadian productivity contracted by 3.1% annualized in the third quarter of 2023, and latest available data that we have. This was the 12th decline in the prior 13 quarters. Canada's output per worker hour has fallen a cumulative 6% since the pre-pandemic peak. It remains to be seen if this can be turned around. So, again, Duff Macklin's looking at this, the Bank of Canada governor, and he's saying, okay, well, we can't. Like, we've got to drop rates to at least support the economy because we're not getting growth. We're not getting productivity gains. And you get that, like in Canada, you would get that. You're looking for reinvestment.
Yeah.
Right? You're looking for investing in technology. You're looking for investment and training in our people.
Yeah.
So at the same time, we're not doing that well as a country. And then I know this will be a controversial, thought for some people watching this podcast, but the reality is we are blessed as a country with natural resources, and natural resource royalty revenue for governments right across the country are absolutely critical in terms of building on infrastructure, training and education, trying to build up productivity, and using that wealth to make the transition to a greener economy. But what we're doing is we're making it difficult to make that transition because we're basically cutting off, the actual resource development revenue that's going to allow us to get to the next stage. It's a very incoherent what we're doing in this country in terms of growth strategies. The U.S. seems to be getting it right. So longer term view, again, Alfred says the Federal Reserve has raised rates aggressively, of course, this year. The side effects of their strategy is, some slowdown of the economy. But at the end of the day, we think that rates are going to come down, and the U.S. will eventually start pushing rates down. The market is messaging that that's what's going to happen. Yeah. So we're cautiously optimistic, notwithstanding all the craziness in this world, that we'll see some continued momentum in the markets as a result of these sort of larger forces working upon it.
Yeah, so our larger corporations, they're like reluctant to kind of reinvest because the debt is so expensive, right? So
yeah, for sure. It's interesting. Yeah, it's a very good point, Josh. Yeah. So it's interesting. The market is, valuing corporations as if their interest rates were lower.
Mm. Oh, okay.
Right?
Okay. Yeah.
So they're repricing the valuations based on, what they think their earnings will be when the carrying cost for debt will be reduced with lower rates. But the practical reality is rates aren't lower. Yeah. So those corporations still have higher rates, and they're going to be reluctant to take on debt and use it to expand in the current context. So I think a lot of businesses, just like people, families, are just waiting for rates to come down before they make, big decisions around either real estate purchases, even selling. You're probably going to wait until rates go down so that the market might improve and there'll be more people in the market looking for homes.
Yeah, it's fascinating. Was there anything else you kind of wanted to touch on with the market?
No, I think those are the main things. So on this particular podcast. Again, if you have feedback for us, don't hesitate to send an email to humphrey'swealthgroup.com, and we'll take your questions and hopefully integrate them into future podcasts. And go to the show notes, because there likely will be some links that will take you to some of the information we've talked about here in this particular podcast.
Yeah.
I think that's it.
Yeah, I in school right now we're doing a lot of it's a lot of math, right? So using different ways of calculating corporations and using debt financing or equity financing and stuff like that. But I love the philosophy and the theorizing is a lot more entertaining than the actual math of it. I gotta be honest.
Crunching those numbers.
Yeah.
Yeah, exactly. So anyway, thanks everyone for taking in the podcast. We will divide this into chapters.
Yeah.
So sections as well, and we'll put out some snippets from this particular podcast as well on different sections that resonate with the audience. Anyway, take care.